Hey future millionaires, what if you buy your favorite car worth $20,000 and use it for 5 years until its life ends? You might be thinking that you are paying $20,000 for the car, right? But what if you divide the $20,000 by 5 years, since you will be using the car for 5 years? If you do so, you can know that your car technically only cost you $4,000 per year. This is what depreciation and amortization lets you do. That is, divide the total cost over a period of time. $4,000 per year looks more convenient than $20,000, right? It's important to note that this is a really simple example. Also, depreciation and amortization are included in what is commonly referred to as accounting income, though it is primarily used by businesses for financial reporting and tax reporting purposes. But what is depreciation and amortization in the first place? And how can you use them to divide the total cost over a specific period of time? Don't think too much, because today you're going to find out everything you need to know about depreciation and amortization. It's time to excel in personal finance and know about these two important concepts. Let's get started. Whenever you buy tangible assets or intangible assets, they come with a cost. But the good news is that you are allowed to divide the total cost of those assets among a certain number of years. And to do so, you have to use two important concepts that are depreciation and amortization. When you own a business, most of your expenses are expensed immediately, which reduces your net income. But the equipment and machinery you bought never stays for a lifetime. Therefore, instead of considering the total cost, you divide the expense of those assets among the number of years they will be used, or however long they last. But why do we divide the cost in the first place? Well, it is done so that the cost per year of a specific asset can be known, and then the tax of its remaining value can be imposed. Now let's find out what is depreciation in detail. Depreciation is a method to divide the total cost of a tangible asset among a certain number of years. Something to highlight here is that depreciation is especially used to divide the cost for only the tangible assets. Tangible assets are those assets that have physical existence and can be touched. So whenever you divide the expense of any tangible asset among the number of years it will be used in, it's called depreciation. And the expense charged against tangible assets is known as depreciation expense. One of the major reasons why depreciation is done is it helps match expense and the revenue it has generated at a particular time. To know how much profit a specific asset has brought without using depreciation, you have to wait for 10 or 20 years until the asset is totally used. However, to calculate it per year, you can simply divide the cost of the asset over the period it will be used. The most common tangible assets that are depreciated are buildings, equipment, vehicles, machinery, and furniture. Something to note here is that land cannot be depreciated, since its life never ends, or it never runs out if you own it once. Let's try to understand depreciation with an example. So let's say you purchase a new piece of equipment for $100,000 that will help you expand your business, but that piece of equipment will last for about 10 years, after which it will be replaced. Therefore, instead of considering the $100,000 that you have paid, divide the cost by the total numbers of years it will last. Thus, by dividing $100,000 by 10 years, you get $10,000. This is the expense that this tangible asset has cost you every year. Considering this amount, and by knowing the revenue it has generated every year, you can easily know the profit. Thus, in simple words, it can be said that depreciation is the method to know how much tangible asset value has been used at a specific time. It's also worthy to note that depreciation may be calculated in several different ways, like straight line, double declining balance, makers, etc., but that's a lesson for another day. That's accounting stuff. Now let's know what amortization is. Amortization is the exact same process as depreciation, but it pertains to intangible assets. Thus, when you are spreading the cost of tangible assets, it is called depreciation. And when you are spreading the cost of intangible assets, it's called amortization. The main purpose of amortization is to know the expense that an intangible asset has cost you and the revenue it has generated at a given point. Some of the intangible assets that are amortized includes patents and trademarks, franchise agreements, copyrights, loan origination fees, and organizational costs. Let's try to understand amortization with a practical example. Let's say you have bought a license of a franchise for $10,000. License will expire after 10 years, which means you can divide the total expense of the license by 10 years. By doing so, you get $1,000, which is the amortization expense every year of the license. After knowing depreciation and amortization, let's compare the two to know the major differences. The key difference between depreciation and amortization is that depreciation is for tangible assets, while amortization is for intangible assets. Another main difference between depreciation and amortization is that tangible assets typically have a resale value at the end of their lives. However, intangible assets do not have a resale value when they are completely used. Also, it's worthy to mention here that amortization is calculated by straight line, while depreciation can be either calculated by, like I said earlier, straight line or some type of accelerated method. In conclusion, we use these two methods that are depreciation and amortization to spread the total expense of an asset over a certain number of years. We do so to know how much a particular asset has cost us per year or per month instead of waiting till the end. This also helps to match the expenses and revenues over a period of time more accurately for investors and creditors. Thus, when we know that a particular asset has cost us a particular amount, we can easily calculate the profit it has brought. This is done by subtracting its depreciated or amortized cost from the revenue it has generated. The difference that we get is the profit that particular asset has brought. To look at depreciation and amortization from another perspective, they are the values of assets lost over time due to the profits they have given. Did you know that you could spread the total cost of an asset? Well, now you can easily do it to create more ease for yourself. Don't be shy to comment right below whether you will use depreciation or amortization for purchasing a new car for your business. Also, don't forget to subscribe to Twisted Finances and press the bell icon next to it to get the daily dose of personal finance from us. Don't miss out on any video about these important financial concepts that can let you achieve financial independence. Until next time, stay tuned.